Hi everyone, welcome to my channel. In this video, I'll be discussing what is Section 199 Cap A deduction and the new safe harbor rule for rental real estate. This extremely complex deduction went into effect in 2018 and is scheduled to last through 2025. So to make this as exciting and simple for all of you, this is going to be a two-part series. In this video, I will discuss the main rules, the theories to understand what this deduction is all about. It is imperative that you understand the rules of this deduction. Then in another separate video, I'm going to have flowcharts with examples of how to compute these deductions under different scenarios. Let's go ahead and jump right in. The Tax Cuts and Jobs Act, TCJA, created a brand new income tax deduction for owners of pass-through businesses. Pass-through owners who qualify can deduct up to 20% of their net business income from their income taxes. The deduction was intended to avoid placing pass-through owners at a disadvantage compared with regular C corporations whose tax rate was lowered to a flat rate of 21% by the TCJA. The deduction is only available with respect to income from a trade or business. While it isn't entirely clear at this point, the new QBID deduction is apparently available to offset net income from a profitable rental real estate activity that you own through a pass-through entity. The unanswered question is, does rental real estate activity count as a business for purposes of the QBID deduction? To provide some certainty for taxpayers potentially entitled to the pass-through deduction, the IRS released Notice 2019-07 in conjunction with the final regulations on January 18, 2019. The notice proposes a safe harbor under which taxpayers may treat rental activity as a trade or businesses solely for the purpose of the Section 199 Cap A deduction. What are the safe harbor requirements? To qualify as a trade or business and be eligible for the 20% Qualified Business Income Deduction, or QBID, under the safe harbor, the rental real estate enterprise must meet the following requirements. 1. Maintain separate books and records for each rental real estate enterprise. 2. For tax years ending prior to December 31, 2023, 250 or more hours of rental services must be performed by or for the real estate enterprise each year. The 250 hours of rental services can be performed by owners, employees, agents, or independent contractors. 3. Taxpayers and tax filing entities will have to implement time tracking systems beginning with 2019 if they're going to rely on this approach, and the 250-hour test will be applied annually. For the purpose of 250-hour rule, rental services include advertising for rent or lease, negotiating and executing leases, verifying tenant applications, collection of rent, daily operation, maintenance, and repair of property, management of the real estate, purchase of materials, supervision of employees and independent contractors. Rental services do not include financial or investment management services, arranging financing, procuring property, studying or reviewing financial statements or operating reports, planning, managing, or constructing long-term capital improvements, time spent traveling to and from real estate. The taxpayer will have to maintain logs to document hours of services, description of services, dates such services were performed, and who performed the service. There are two real estate categories that do not qualify for a 199 Cap A treatment under the safe harbor. They are 1. Real estate used as residence for any part of the year, including vacation homes and second residences. And 2. Triple net lease real estate, where the tenant is required to pay all of the taxes, fees, insurance, utilities, and maintenances associated with the building. If you're not able to rely on the safe harbor, you should work with your CPA to review and compare your rental activities to the trade or businesses under the Internal Revenue Code Section 162 established by the IRS and the courts. Now, for those of you that qualify for this deduction, you'll effectively be taxed on only 80% of your rental and/or business income. Thus, the effective rate for taxpayers in the top 37% tax bracket is 29.6%. Here are 3 basic requirements you must satisfy to qualify for this deduction. 1. You must have a pass-through business. You have to have a pass-through business to qualify for this deduction. This includes any business that is a sole proprietorship, a partnership, an S corporation, LLC, or LLP. For tax purposes, what distinguishes these type of business is that they pay no taxes themselves. Instead, the profits or losses from these businesses are passed through the business, and the owners pay tax on the money on their individual tax returns at their individual tax rates. 2. You must have qualified business income, or QBI. Individuals who earn income through pass-through businesses may qualify to deduct from their income tax up to 20% of their QBI from each pass-through businesses they own. However, your actual deduction may be less depending on your taxable income and occupation. QBI is a net profit your pass-through business earns during the year. You determine this by subtracting all your regular business deductions from your total business income. QBI does not include short-term or long-term capital gains or loss, example, capital gain or loss earned from selling business property. It does not include dividend income, interest income, wages paid to S Corp shareholders, guaranteed payments to partners in partnerships or LLC members, or business income earned outside the United States. If you're a member of a multi-member LLC, a partnership, an LLP, or an S Corp, your QBI is determined at the shareholder partner level. This means each shareholder, partner, or other owner takes into account his or her pro rata share of the pass-through business's income, deductions, gains, and losses. What if you have a business loss? QBI is determined separately for each separate business you own. If one or more of your businesses lose money, you deduct the loss from the QBI from your profitable businesses. If you have a qualified business loss, that is, your net QBI is 0 or less, you get no pass-through deductions for the year. Any loss is carried forward to the next year, and the pass-through deduction for that next year or the next future year with a positive QBI is reduced, but not below 0, by 20% of the loss. So for example, during 2018, L earned $20,000 in QBI from his bike rental business and had $50,000 loss from his restaurant business. He has a $30,000 qualified business loss, so he gets no pass-through deduction for 2018, and his loss must be carried forward to 2019. His pass-through deductions for 2019 must be reduced by 20% of his $30,000 loss, or $6,000. 3. You must have taxable income. To determine your pass-through deduction, you must first figure your total taxable income for the year, excluding the pass-through deduction. This is your total taxable income from all sources, business, investment, and job income, minus deductions, including the standard deductions, which is $12,000 for singles and $24,000 for married filing joint in 2018. However, you do not include net capital gains for the year in your taxable income. since such amounts already receive preferential tax treatment. If you're married and filed jointly, include your spouse's income in your taxable income. Very important point here. Your pass-through deduction can never ever exceed 20% of your taxable income. This limitation will apply and reduce your pass-through deduction to less than 20% of QBI if you don't have enough non-business income to offset your personal deductions, which reduce your taxable income below the amount of your qualified business income. If your taxable income exceeds $157,500 if single or $315,000 if married, calculating your deduction is much more complicated and depends on your total income, the type of work you do, and whether you have employees or business property. Are you a specified service business? As I just mentioned, your deduction depends on the type of work you do. So first you need to determine whether your business is a specified service trade or business. This is a business that falls within one of the following categories. Health, such as doctors, dentists, nurses, etc. Law, accounting, consulting, performing arts, athletics, brokerage services, financial services, etc. There is a final catch-all category that includes any business where the principal asset is the reputation or skill of one or more of its owners or employees. This may include a hairstylist, auto mechanics, etc. Somehow, architecture and engineering services are expressly not included in the list of personal services. However, an architecture or engineering firm whose principal asset is the reputation or skill of its owners or employees would presumably fall within the catch-all provision. The pass-through deduction is a personal deduction you take on your Form 1040 whether or not you itemize. The deduction only reduces income taxes, not your Social Security or Medicare taxes or net investment income taxes, which is a 3.8% tax paid by higher income people on rental and investment income over certain levels. One of the planning strategies to maximize the pass-through deduction is to keep service business income below the $207,500 or $450,000 threshold. I know you're thinking, duh, but how do I do that? Well, here's how you do it. Make sure you keep track of your taxable income during the year, especially if your business is a specified service business. It's absolutely vital to keep your taxable income for the year below the cutoff amount. If you earn $1 more than this, you get no deduction. Your taxable income is your total income, not including capital gains, minus your deductions. So if your income is at or near these limits, there are lots of things you can do to reduce your taxable income for the year. For example, you can 1. Contribute to retirement accounts such as IRAs and 401ks. Your contributions are deducted from your taxable income subject to annual limits. In 2018, business owners can contribute up to $55,000 to retirement plans. In my future presentation, I'll be going over different types of retirement plans for business owners, so I invite you to watch my video. 2. Give money to charity, but make sure you're able to itemize your personal deductions. 3. Avoid billing clients or collecting amounts due to your business near the end of the year. 4. Increase your business deductions to reduce your taxable income. For example, buy equipment or other property for your business. All the long-term personal property you buy for your business is 100% deductible in 1 year using 100% bonus depreciation or Section 179 expensing. Well, I hope you enjoyed my video. Stay tuned for part 2 of Section 199 Cap A deduction, where I'll be going over how to calculate these complex deductions. So please subscribe and give me a thumbs up.